So next, Steve, is MongoDB, which we've covered a number of times. Another tech company. They're sort of I guess they're in the database space. Document databases is their key area, and they're one of the market leaders in the space. I know a few of the modern banks are fans of MongoDB. They build their tech stack with MongoDB in it, and I've heard a lot of glowing reports about it. So I've known about this company for a very long time. Unfortunately, didn't invest in it when it was like 5p, and now it's quite expensive. But I have bought it once and sold it, and then went on to buy it again and sold it again when it was quite expensive. And right now, Steve, it's coming right into that kind of range where I start sniffing around it. But here's the revenue and the profit, and we'll have a chat about it, Steve, and see what you think. Revenue was 548.4 million, up 20% year over year. That completes a 50% revenue CAGR for them over the last 10 years. MongoDB, which is impossible, Steve, if you listen to some people on Instagram. Impossible. If they can't do it, impossible. Buy this tat that grows at 1%. Yeah, because 50 is impossible. And
we're getting there. We're getting there in a moment. Don't worry, it's Greg's next.
Put serious numbers in your DCF. Yeah, 50 is not possible. Yes, MongoDB Atlas, which is it's kind of their flagship product, I would say, is now representing about 71% of revenue, and that's growing at 24% year over year. So, yeah, just to kind of show you the flagship product is growing faster than the overall number at the top. So, full year revenue for 2024 was 2.01 billion, growing at 19%. Net loss was $129 million, about $1.73 a share. Significant customer growth. They surpassed 54,500 customers. Q4 highlights included a net income of $15.8 million, about 20 cents a share, compared to a net loss of $55.5 million in the year period. So at least that gives you a figure to look at moving forward, Steve. You're starting to see a little sniff of net profitability. Note developments, they acquired a company called Voyage AI, and they said this is to enhance AI-powered applications. They've also completed all of their early completion of their 2026 convertible notes redemption, which has eliminated all company debt, and they've announced a $200 million stock buyback program. Their company is in pretty good nick. It's about 2.3 billion in cash and cash equivalents at the moment, Steve. So 200 million is not much. Also, for the third consecutive year, it was a leader in the 2024 Gartner Magic Quadrant, which for anybody at home is Gartner assess companies for their ability to execute and the completeness of the vision. They compare them against everybody else in that space, and they give you this sort of quadrant, which is a graph which shows you who's the furthest along to who's the best execution and who's the closest to the sort of completeness of vision, and they give you like leaders in the space. And that's what MongoDB was in this one for. Cloud database management systems, essentially, which is their core competency. So in terms of the guide, Steve, on the quarter, they said 524 million to 529 million and 2.24 billion to 2.28 billion. So it's not too bad growth, but it's not the best. They've not guided now for 5 straight years above what the street wanted on their initial guide. They tend to sandbag the initial guide and then lift it over the course of the year. The market falls for this trick every first sort of quarter, it seems. But that didn't stop the analysts. So Citizens, they lowered the price from 380 to 345. Stifel, they lowered their price from 425 to 340. Oppenheimer, they went from 400 to 330. Canaccord, 385 to 320. RBC, 400 to 320. Morgan Stanley, 350 to 315. Wedbush, 360 to 300. B of A went from 420 to 286, which is a huge drop. But they actually gave it a buy rating, saying that FY26 revenue and margin outlook look weaker, but acceleration seems likely. So yes, big drop in all of those prices, and the market really agreed with them, sent it down 30% on the 5 days. It's actually, though, trading at 189 USD, so there wasn't a single one of them saying that it should be around that kind of mark. The lowest was 286, 189 to 286, huge jump. And if you want the top end, it's essentially a double. I don't think that's quite on the cards, Steve, for especially for an analyst short-term price target. But I think it's probably worth a little bit more than it is today. Market cap down to about 14 billion, and it's only because it's had a decent recovery today. It got as low as the low 13 billions. But yes, I think it's a pretty interesting looking company, and it's on the watch list of things to just watch at the moment, Steve.
In my case, it's on the list of things that I'm pretty sure you'll update me about. I never fully understand these analyst price target things, and that's not a sly way of saying they don't make sense. I'm pretty sure it's a feature about me, not a feature about them. What I would say is, even on the lowest of that, you said B of A down to 189 still had a buy, down to 286, the stock at 189, now 187, by the way, still had a buy rating on it. I guess if I was an analyst and I was looking at a stock that's currently trading at 18 anything and sticking a 286 target on it, I find it very hard to assign anything other than buy to it, because I feel like people would, or at any rate, if I saw an analyst who had, from my non-analyst position, if I saw an analyst who had done that and put anything other than buy, I would struggle to process any of their other recommendations. So most of them tend to be things that they think are maybe 20% higher than they currently are, and they're saying buy. And I understand that, but I would struggle to see what anyone thinks is a buy unless it's a weird Tesla valuation. Or even then, the gap between 189 and 286 is huge. So yes, it pretty much has to be a buy on more or less any analyst scorecard, but it's not a buy on ours. It's a buy on it's a kind of sit and watch and see thing on ours. But yeah, down 30% because they've managed a 10-year CAGR of around 50 or so, you were saying, on the top line, and they're guiding for what looks like a kind of run rate of basically nearly nothing. So between 524 and 529 on 2 nothing, basically. So roughly 2 billion. So yeah, I mean, they are guiding for, and I'm not saying this is what's going to happen, very, very sharp slowdown in revenue growth in that case. Convinced? That's the big question, as you were saying here. It would be, I can see why it's disappointing if you buy that guidance, but I think there is a general theme here, Steve, emerging today, or this week's theme, is people have been looking at stocks quite recently, and when you first start looking at a stock, you can kind of find out its history because you can dig back and look a bit, but unless you've really been through a load of reports, which I generally don't, to be honest, when I first start looking at these things. I've got a stock coming up that I've been looking at recently for the first time, and I haven't done the full kind of history wade through yet, but there are things that you kind of gradually build up an understanding of here, and I do wonder maybe how long the analysts have been on this one. You said you've been on this for ages and ages and ages and ages, and generally speaking, they start the guidance low and work it higher, and the stock goes down at the start of the year every time. It makes a kind of nice annual trade, I guess, potentially. But yes, so that's really weak kind of growth outlook. It's some fascinating stuff going on with this company, though, I think. So 2.3 billion in cash on what was initially a low 13s market cap takes you down to nearly 10 billion, which makes it look kind of cheap, maybe. If you think they're actually going to grow past this 2 billion thing, you could start getting this to nearly 3 and a bit, 4 and a bit times sales here, which is really quite. What am I looking at? Yeah. So that goes up a bit. So you get into sort of 4 and a bit, a little bit more than that times sales for the year forward, which is not crazy. Margins don't look like they bear that out at the moment, but this is still kind of early for that. And the fascinating thing, I guess, to me is that despite being, this will be GAAP non-profitable, they're quite happy to buy back their stock at the moment. And in fairness, you now get 30% more for your money on this thing. It's almost a kind of unprofitable dividend stock that you shouldn't worry about because there's actually plenty of cash around to pay this uh, dividend slash buyback thing. I can see why they don't want it to be a dividend, by the way, but 200 million on sort of nearly 10 in enterprise value is a 0.2. Well, worth paying attention to, I guess. And customer growth staying strong is what you could really want to see from a growth stock. So, yeah, it's hard to say this is a good report if you take the guidance at face value, because I think that guidance looks really quite weak. It also looks quite implausible to my eyes. So I'll be fascinated to see what happens in the next 3 months or so when they report their next round of stuff. But a 30% discount, this is the one, by the way, I said at the top of the long version of our show. I wasn't sure whether this one was up or down this week. It's very decisively down in that case.
Yeah, so there's a few things I would just add to that, Steve. Is that obviously it's a tech stock and it's a software company, so stock-based compensation is something that you've got to keep an eye on. So they'll be quite comfortably free cash flow positive, but the net income will be negative just because that stock-based compensation is coming off that number, even though it's actually a non-cash charge, which is how you can lose money for 10 years straight and have a bigger cash balance than when you started. That's just how that works. Unfortunately, it's a strange accounting system that we all signed up to. So the interesting part on that, Steve, is that they've now flipped that because Q4 they were net income positive, $15.8 million. So I mean, by the end of this year, if that keeps growing, and you bought today, you could be looking at a company that's trading at, perhaps 100 times earnings, only just flipped to profitability, but has grown essentially the last 10 years at 50% CAGR, which if you gave me those figures on an evaluation, I would, probably snap your hand off. The other thing to note is that this is an AI adjacent kind of company because it's a database company. It needs the apps to be going onto people's phones, the AI apps that do certain stuff, before it starts to be able to recognize any revenue. So there's been this huge AI demand and build out, and you've seen the companies that have benefited from that. They're the companies that are in the kind of, let's call it the inferencing stage of AI. They're the ones that have made the massive amounts of money. But when we move from that inferencing onto actually trying to get something in front of the consumer, apps in front of the consumer, that's when MongoDB will have a fantastic time of it, because that will more than likely be the one of the databases used to get those apps out to market. So it's kind of like, it could be the calm before the storm. It depends on how you feel about AI. Obviously, the market collapsing like this, you may have completely changed your mind month over month on how you feel about AI. I would encourage you to just think deeply about these kind of things, because at 13 billion, you've got a company here that is essentially one of the market leaders in document databases, really highly regarded and not cheap. It's one of the more expensive products on the market, but it's seen as a premium product. And these AI apps, they're going to want to be quick. And I think MongoDB is probably going to be the one that comes out. Well, I mean, there's a potential for them all to come out smelling of roses. If you look at that spend that's been spent onto inferencing, eventually some of that spend has to start trickling up the chain to, production of apps. And when that happens, MongoDB should be one of the beneficiaries. So it's on that watch list, Stephen. We'll see how we go.
Yeah, slightly interesting for higher up the chain. The last time we talked about this, which was probably about 3 months ago, I actually paid attention and tried to figure out in my own head exactly what this does and what the difference between it and other kind of software companies are. It's a really interesting database building thing. So the way I sort of thought about it is, if you want to store kind of customer records and so on, you could bang it into something like a spreadsheet, but the trouble is people have different basically data points. Some people have a home phone number, some people don't have a home phone number. So if you want to try and store all this information adjacent to various things, you need a column for home phone number that has one person's number in it, and then work phone number that has another person's number in it, and so on and so forth. And MongoDB is just a better way of databasing this stuff. You can expand and contract your a kind of digital filing system like this to make it work much more efficiently. And I think that's a really interesting kind of space to be in. You mentioned it's very popular with banks, and you can kind of see why. Second week running, we've been talking about a kind of well, this isn't specifically a bank, I suppose. Neither was Celebris, but a bank tech stock, and it's interesting to see the kind of niches that these companies get themselves into. I think.
Yeah, I think that one of the ways to think about it is if you think about a filing cabinet, where you work, if you open it up, the likelihood it's in alphabetical order, and if you need to find something by picture, you're going to have no way of doing that because if you don't know the guy's first name or whatever, you won't be able to find him in the file. Whereas with MongoDB, they become infinitely more searchable because they can stash all different types of information of all different types of information within them on types of file and what have you, and it makes them infinitely more searchable, which makes them a lot easier to use and obviously customizable going forwards as well. So yes, that's where they win. They win in flexibility. But they're not the only document data provider. I think Oracle has a pretty big document database arm as well. But so far, MongoDB has done very well at competing against them, Steve.
You've been watching a segment from the PlayingFTSE Show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.